Everyone thinks the meat industry is about farms and factories, but in 2025, it's actually a high-stakes chess game played with balance sheets and automation algorithms. We are moving from the era of quantity to the era of margin resilience. If you're still valuing these companies like it's 2010, you're essentially bringing a knife to a drone fight. This analysis is the survival guide for the 2026 divergence. Why is Shuanghui printing money at 37% gross margins, while Western giants are gasping for air at 15%? It's the margin paradox. In this industry, scale is no longer a safety net. It's a trap if you're not vertically integrated. When raw material prices spike, the, quote, pure processors get slaughtered, while the integrated players just move money from their left pocket to their right. It's the difference between owning the casino and just playing the slots. Here is the too long didn't read for the C-suite. The industry is splitting into two species, the agile CPG giants and the struggling commodity grinders. Vertical integration and deep processing are the only moats left in a world of 5% inflation. Without them, you're just a glorified logistics company moving protein from A to B for zero profit. It's like trying to run a marathon while carrying a lead-weighted backpack of legacy costs. Look at Conagra. 82% of their revenue is in prepared foods. They aren't selling meat, they're selling convenience. Tyson, on the other hand, is still 80% commodity heavy. In a downturn, Conagra is a fortress, while Tyson is a tent in a hurricane. Escaping the commodity trap isn't a choice anymore. It's an evolutionary requirement. If you're still selling raw slabs of protein, your margin is thinner than a slice of budget deli ham. The donut chart doesn't lie. Value-added segments are the alpha of this sector. Shuanghui's package division is running a 27% operating margin. That's software-level profitability in a hardware-level industry. Meanwhile, fresh protein commodities are basically a charitable contribution to the consumer. The takeaway: if you can't brand it, you can't bank it. Conagra generates $634,000 per employee. Tyson? Barely $400,000. Why? Because robots don't take sick days or ask for dental plans. The automation frontier is the new battlefield. High-efficiency CPG models are generating 1.5 times the output per human. In 2026, your headcount is actually a liability unless those heads are overseeing an army of stainless steel sensors. Now let's talk about the skeletons in the closet: Goodwill, bubbles, and debt. The next few slides are the forensic portion of our tour. We're going to see who's actually built on rock and who's built on expensive debt-fueled sand. Earnings are an opinion. Cash is a fact. Hormel's 1.77x cash conversion ratio is the gold standard. It means for every dollar they claim to make, they're actually putting nearly $2 of operating cash in the bank. This is the ultimate BS detector for investors. If the cash isn't there, the earnings are just creative writing. Kraft Heinz just vaporized $9.3 billion in Goodwill. That's enough money to buy a Tesla for every single person in New York City. This is the sword of Damocles. When interest rates rise, these bloated balance sheets start to look like ticking time bombs. Conagra's Goodwill to assets ratio is over 117%. If the market sneezes, that valuation catches pneumonia. Tyson and JBS are playing a dangerous game with interest coverage ratios below 3x. In a world of higher for longer rates, they are one bad quarter away from a credit crunch. Smithfield, however, is sitting on a fortress with 31x coverage. Being debt-heavy in 2026 is like trying to swim across a lake with your pockets full of gold bars. Eventually, you just sink. Bypassing a 47% tariff wall requires more than just logistics. It requires geopolitical gymnastics. Multi-origin sourcing is the only way to keep the plates moving. Whether it's sourcing from Europe to serve China or vice versa, the winners are those who treat the globe like a single kitchen. And yes, all this is done under strict UN-1 China protocols. It's about being global, but acting local. We're entering the end game. The next 3 years will be defined by 3 words: sanitize, automate, and integrate. If you aren't doing all 3, you're just waiting for the liquidation auction. CapEx is no longer about more. It's about better. We are seeing billions shifted from capacity expansion to yield optimization and robotic capture. Every dollar spent on a robot today is a dollar you don't have to spend on labor litigation tomorrow. This isn't just a factory upgrade. It's a structural defense of the bottom line. The plant-based bubble hasn't just burst. It's been incinerated. Conagra took a $91 million hit on Gardein. Meanwhile, artisan meats and snackification are thriving. Turns out, People actually like the taste of meat. Who knew? The lesson here: innovation without taste ROI is just a very expensive hobby. Why fight for 5% margins in a supermarket when you can get 14% in a restaurant kitchen? Hormel is winning by becoming the sous chef for the entire QSR industry. By providing labor-saving, pre-cooked proteins, they are solving the labor crisis for their customers while padding their own pockets. It's the ultimate win-win in a high-cost world. Here is your cheat sheet for the next earnings call. Watch the accounts receivable. If AR is growing faster than sales, they aren't selling meat. They're stuffing the channel with IOUs. It's like pretending you're rich because people owe you money for lunch. Eventually, you still go hungry. In this business, freshness is a math problem. Tyson and Shuanghui move inventory in about 40 days. Conagra takes 86. When you're dealing with perishables, every extra day in the warehouse is a day of lost margin and increased risk. A 40-day cycle is a Ferrari. An 86-day cycle is a delivery truck with a flat tire. Bacon and sausage are the alpha growth drivers. They are the high-velocity anchors of the modern plate. Plant-based Gardein? It's currently a value-destructive anchor dragging down the ship. The data is clear. Stick to what the consumer actually craves, and the margins will follow. The era of volume-driven expansion is officially dead. The decade of automation-protected margin capture has begun. If you can't automate it, if you can't integrate it, you won't survive it. The winners of 2026 will be the companies that treat their supply chain like a high-frequency trading algorithm. If this analysis made you realize your portfolio is more ground beef than prime rib, it's time to level up. Drop a comment below on which player you think will win the 2026 margin war. For the full-page deep dive intelligence report, email us at sales@HDINresearch.com or click the link in the description. Don't forget to follow at HDIN230 for more forensic market breakdowns.